Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hi there. Welcome to the COB. We hope you're doing well today, unlike the market.
Absolutely. I'm Juliet Sully. This is Nadine Blaney. We're very close together. Let's quickly have a look at the overall market.
Oh my God.
Yes, there we are. We are down 0.7%. Of course, quite a bit of weakness coming through in the market today. And it's really all about these concerns about Trump really ramping it up with, it wasn't just, talk. He really is serious when it comes to these tariffs. The other thing that happened just as we went to air was Trump saying they're going to halt aid to Ukraine. So a lot of, nervousness in the market today.
Yeah, uncertainty. Investors don't like uncertainty, that old adage. We were down as much as 1% early in the session. So we've picked up a little bit of ground, but nothing to write home about, certainly not. So what we're all digesting is what exactly these tariffs will mean. Will we see retaliation coming from the likes of Canada, coming from the likes of China in particular? We didn't hear anything on that front through this Asian session so far. But what it has done, Juliet, is it's now got the Fed funds futures rallying. So markets are now pricing further 76 basis points of US rate cuts for 2025. And I think that's also a reflection of, the slowdown that we're starting to see in the US economy as well.
Yeah, although it was interesting to hear from Goldman Sachs CEO today saying, look, he says the chance of a recession in the US is not zero, but he is certainly not, factoring that in. He said the tariffs are going to really kind of level the playing field somewhat. Interesting what Matt Commons said, not expecting cuts until the end of the year.
Yeah, so he was at some sort of an AFR summit saying that he wouldn't be surprised if we don't see further cuts really until later this year. So just an evolving rate situation. And I thought it was really interesting, a conversation I had with Chris Weston from Pepperstone earlier on today, and you can find that online. Just back to the sort of Fed funds future rate, talking about the new U.S. administration, Scott Bessent, the U.S. Treasury Secretary, looking to sort of manufacture lower yields. So whether or not that's a fact, he has indicated that he would like yields to be lower, Treasury yields to be lower in the United States. So there's just plenty on the platter, I suppose, for investors to pick and choose their worries right now. And that's really resulted in a slump, not just here in Australia, but around the region as well.
All right, let's get into some of the sectors of the day. Worth noting as well, we had the RBA minutes today as well, which were quite hawkish. Paul Bloxham from HSBC telling me he doesn't factor in another rate cut till potentially the third quarter. So just on the back of what you were saying there. All right, having a look at energy stocks, of course, OPEC increasing production for the first time since 2022, really just saturating this already saturated market potentially. So a lot of weakness coming through from energy players and crude oil at its lowest level for 2025.
Yeah, so adding to the wall of worry, of course, tariffs. We've also got the fact that we don't have this critical minerals deal signed between the United States and Ukraine that's put pressure on lithium stocks, but iron ore is under pressure. So we've got Fortescue down by 3.5%. We've got Mineral Resources giving up all of yesterday's gains and then some, down by close to 10%. Mineral Resources was also mentioned on the call today, so I'll let you go and listen to that episode if you'd like to know what my guests had to say about MinRes.
Well, the other interesting part about the iron ore futures picture, right, is that it's the MPC in China, so they've turned all the factories off so they get those blue skies. So that's why we've got that pressure on iron ore. Looking at the healthcare sector, mainly, of course, defensive on a day like today, CSL and Cochlear, both looking very solid. And then to the story. Yeah,
we've got Newmont completing the sale of 3 mines as part of its non-core asset divestment program. So we've known that this is coming, valued at about $1.7 billion US before any adjustments being made at closing.
Qantas shares extending their record. Now, they were about $5 at the end of 2023. They've doubled in that time. They had that really good profit. They've returned shareholder dividends, and a lot of brokers upgrading their target on Qantas.
Insignia, though, it declined a request to redeem $200 million of subordinated loan notes. So I think NAB declined its offer. So Insignia will now have to pay a 4% coupon. So that's up from 1%. And an additional $53.5 million.
The government here in New South Wales considering a range of contingencies on the Star Casino. Minister for Gaming David Harris saying he can't keep plunging taxpayer money into casinos, so they would put an arrangement in place to save jobs, but there's a limit to what they can do. And of course, Star does not look like it's going to survive
Well,
on the market.
Look, I mean, I feel for people who work at the casinos, but as a taxpayer, this is a publicly listed company. There's only so much, I would agree, that should be done. And also, just, I guess, dovetailing off Star, we've got Healthscope failing to pay all of its rent due to the HealthCo Healthcare for March 2025. So it looks as if we've got those rent woes and the woes in the private healthcare system, now hitting HMC as well.
And a couple of other stocks on our radar, including Alcoa falling after its miner announced a $1 billion debt offering, and Lynas, of course, you mentioned there, the US-Ukraine mineral deal potentially not being signed.
So, what does Henry Jennings have his eye on today? He, of course, is from Marcus Today. Welcome to the COB again, Henry. Put this fall that we've seen in context for us today.
I do feel like a thorn between two roses with you two hosting this afternoon. So I guess, we have seen just increased volatility and uncertainty, and that is certainly playing out. These tariffs, which I guess the market was getting used to the fact that we were having tariffs as a negotiating tool. But that doesn't seem to be the way of things now. We've already had Canada, I think, just recently has come out and said that they will retaliate with their own set of tariffs on around $160 billion worth of US trade. So we are staring down the barrel at the moment of a US-inspired trade war around the world, and that is certainly unsettling markets. And there will be some winners and some losers out of the tariff war. What concerns me, of course, is that inflation will take off again, and this is something that we saw during COVID, and companies were very keen to raise prices during COVID and blame the supply chain issues. Now, there is a potential, I guess, for companies to do a similar thing and raise prices here because of tariff issues. We're not sure who's actually going to pay for these tariffs. And in that sort of uncertainty, companies can raise their prices. And what tends to happen is those prices go up, but they don't ever seem to come down when the pressure is off. We certainly saw it with COVID. Once COVID returned to normality in terms of the supply chain, we didn't really see tariffs or the prices ease back in a big hurry. So
yeah, well, Henry, I hate to interrupt, but we had alluded to it earlier that we could see some retaliation coming from China. And breaking news right now coming to us that China's finance ministry has decided to impose tariffs of 10% on U.S. agricultural products, including soybeans, sorghum, pork, beef, aquatic, fruit, vegetables, and dairy products. So additional tariff measures of up to 15% on some U.S. goods, and to impose additional tariffs on some U.S. goods from March the 10th, also going on to chicken, wheat, corn, and cotton. So we do have China saying that it will impose tariffs of between 10 and 15% on Chinese imports, select Chinese imports, from the 10th of March.
Yeah, well, there we go. We're obviously seeing a ratcheting up, and it's a big week for the Chinese as well. So, there's I can't see too many winners in this whole exchange of tariffs at the moment. Certainly not the stock market, that's for sure. But interestingly, Juliet, when you're talking about Scott Bessent and his desire to get interest rates down in the US, and the fact that we've got the US 10 years falling quite considerably from those recent peaks, at least that's job done. Also, the fact that they are getting the oil price down as well, so that's another job done. But the problem is the reason we are seeing these falls, I guess, in the especially in the Treasury market in terms of yields, is that the economy in the US is slowing down, and it's hardly a surprise. If you're sacking federal workers en masse, there's that old saying about Kevin Bacon, and we're all 7 degrees of separation away from Kevin Bacon. If you're a US citizen, you would know at least somebody that has had their job cut due to the efforts of Elon Musk and the Doge squad. So, that does instill a bit of fear and loathing in the US consumer, and we're seeing that at the moment with the US economy slowing down.
I think you added an extra degree, 6 degrees of Kevin Bacon, Henry.
Is it?
Yeah.
I don't know him that well, Julia.
Well,
obviously.
I'm just only one away. No, of course not. I'm not. Never met him. Let's talk more about what we're seeing more broadly at home, because the RBA minute's really quite hawkish, although potentially nothing. We hadn't heard from the press conference afterwards, but it certainly does seem that everyone's pushing out these imminent rate cut expectations. What does that mean for the economy, and I guess in terms of the backdrop of the retail sales picture we had today as well?
Well, the retail sales came in pretty much as expected, and the hawkish comments from the RBA were pretty much as expected as well. We knew that. We knew that the RBA was being dragged a little bit screaming and kicking to cut rates as they were. They'd got themselves boxed into a little bit of a corner, so they did have to cut rates eventually, and they have. But I don't think we're going to see any rate cuts for a little while. And of course, we've got the added wild card, the joker in the pack, which is the federal election coming up. And already we're seeing money being splashed around, whether it's for education, whether it's for aged care, nursing, and those sorts of things. So we are seeing money being pushed out into the economy, which has the potential, of course, to raise interest rates through inflation rearing its ugly head and pressure on the jobs market, which is already pretty much, we've got pretty much full employment. So there are some risks there. So I think the RBA is pretty wise to be cautious on the outlook, and given what's happening globally, it's very wise to be cautious. But yeah, no rate cuts for some time. Let's wait and see how the dust settles in the next 6 months, I suspect.
So the CNN Fear and Greed Index is in extreme fear territory, but of course we've got our own fundamentals to look at here in Australia in the wake of reporting season. When you think about some of those companies that have outperformed in the wake of it, Harvey Norman getting upgraded today, Qantas, as we mentioned. I mean, where were your real winners from reporting season that you think can weather this very headline-driven market right now?
Well, Nadine, it was a very much a mixed picture in reporting season. If you failed, you got absolutely mahulled and punished seriously. There has been some winners, obviously, and there has been some upgrades along the way, but they tend to be a bit washed over, I guess, in terms of when the markets turn this negative to some extent. But certainly, we have seen some companies that reported very well, and those tended to be at the beginning of reporting season back in the early days of February. I mean, even JB Hi-Fi, which is obviously very exposed to the retail sector, at the time it felt like it was kind of a beat, it felt kind of positive, but it's now been swamped in the negativity surrounding the rest of the economy. So I think we've got to be a little bit careful that even the good results are now starting to get washed with this negativity. And of course, after the February reporting season, we get the ex-dividends as well. So the market goes ex-dividend, which again puts pressure on the market going forward in March. And Julius Caesar was right. Maybe we've got to be a little bit wary about the Ides of March at the moment, which is coming up in a week or so's time.
Yeah, I'm trying to explain to all the young players how important it is to watch all those ex-dividends, and then of course when the money hits the market. Henry, I'll see you on the call tomorrow. Thanks as always. Henry is a View contributor today as well in the newsletter. A day
looking forward
late,
to that.
So on the payroll, Henry, thank you so much. Only
Thanks, girl.
7 degrees from Kevin Bacon is Henry Jennings. All right, the stock of the day, Tesla.
Yeah, well, there wasn't a whole heap of corporate news out before we did today's edition of The Call. And I just thought, in the context of Elon Musk and the chainsaw that he's wielding in the United States, the fact that Robin Denham, who is the chair, has sold another massive partial of Tesla's shares in the wake of doing the same thing last month. I thought we'd discuss Tesla. Mark Moreland, Value 3, and Michael Wayne from Medallion Financial.
But it's not just a car company, it's all about the autonomy and where that's at the moment, which is very, very close, I think, to being realised. And if he is dominant in autonomous driving, I think most of the other car manufacturers will cave and then just they'll just license his technology. And then if he dominates that whole area, that is a massive area which is going to generate an incredible amount of money for Tesla shareholders.
Trying to apply traditional valuation metrics to a business like this when it's a non-traditional type company is a very challenging thing to do. There's no doubt you have to back the individual on this, and that is problematic for a lot of people. But look, you have to sort of back him, I think, in the long term to deliver, not necessarily in all these things at once, but to pull off one or two of the projects that he's working on, the mega projects that he's working on. So given the size of the pullback, if you're going to look to buy Tesla, now is as good a time as any.
So down 28% in the month of February. It was off overnight as well, and both of my guests saw it as a buying opportunity.
Yeah, that's what Luke Larrative from Seneca told me today as well. Amidst all the selling we're seeing today, you got to look at it as a buyer. So let's see those stocks that did perform well today. including Linus. We touched on why Helios up 2.7%. I thought it was quite interesting that Lottery Corporation was doing well, because this was on when all the bad headlines were hitting around 10. I thought of people just going, okay, I'm going to pay the lottery amidst this unprecedented time. Qantas, of course, getting a broker upgrade, and Waypoint REIT up 1%.
So if we take a look at what went wrong with some of these companies, Mineral Resources, there's some questions about it fundamentally. It just seems to go with the sentiment as well toward iron ore, uranium as well in terms of Boss Energy. Zipco, look, the share price coming under pressure today. We had a change in director's interest notice coming out today. Nothing else that I can see. Pinnacle Investment, probably a reflection of what's going on in markets in general, and HMC Capital, we mentioned that story with Healthscope.
All right, having a look at the small end of town. Gorilla Gold Mines, this was one of Jonathan Takadina's picks on the trade today. Gosh, he can pick the gold players, can't he? Up 9%. American Rare Earths doing well. Melbana Energy, Shine Justice, and Encounter Resources.
On the flip side, though, Antinogen Medical, Imricor Medical Systems, and Magnetic Resources on that list, anywhere between sort of 9 and 19.5% lower.
All right, tonight, EU unemployment rate, and we also hear from one of the FOMC members speaking tonight.
And tomorrow, we've got the National People's Congress, so the NPC in China beginning, usually lasts about a week. We've got our quarterly GDP read, and to your point, a number of those companies trading ex-div.
Indeed, including Coles and Woolies on the same day, and QBE and Treasury Wine Estates. All right, checking where the market is. Not a good day.
No, not a good day. So the CBA Australia Index finishing off by 0.7%. That's pretty much reflected on what we're seeing for the S&P ASX 200. I will note, though, that US E-minis are mildly higher at this stage of the session, but I do think it's worthwhile that, a firing shot has come from China in relation to those threatened tariffs coming from the United States. So putting anywhere between 10 to 15% on various US agricultural products from the 10th of March.
All right, so we will see how all that plays out into the US session and again into our market, remembering as well that the NPC will be happening too. We'll be back from 9:45 a.m. Eastern on Wednesday.
See you then.